Now, in order to understand the profession of auditing better, it's noteworthy to look back on its origin and how it evolved through time until what it is today. Auditing initially existed primarily for governmental accounting, and it was concerned mostly with record keeping rather than accounting procedures. It wasn't finally until the Industrial Revolution, roughly that was from 750 to 1850, that auditing began evolving into a formal profession. It initially focused on fraud and error detection until later the objective had been more refined and aligned to what the objective of audit is today. So which is, as mentioned earlier, the expression of opinion about the fairness of the financial statements. So finally, advancement in business and technology paved way for the development of the profession, and corporate and accounting scandals continue to calibrate the profession even until today to address the changing needs of various stakeholders. Auditing dates back as far as the earliest human civilization, such as those in early Mesopotamia, Egypt, and Babylonia, where earliest records of documents already show signs or indication of the audit function, like check marks, dots, and other symbols being performed on them. Thus, ancient merchants and people those days already perform some form of auditing even before the term auditing has been first used or adopted. Actually, the word audit came from the Latin term audere, which means to hear or to listen. Hence, in our human anatomy, our ears belong to what we call the auditory system. Because centuries ago, when common people do not know how to read and write yet, the kings and lords have a trusted person who listen to servants as they describe the resources that were entrusted to them. The king or the lord's trusted personnel who is doing the audit function notes any error or inconsistencies based on what they hear from the servant or peasants. However, the concept of auditing public expenditure and even financial management by an independent body has its roots in ancient Greece. Philosophers during that time, starting from Plato, stated that people running the government should be accountable to the resources entrusted to them and should report to the people who elected them on how they exercise the power conferred unto them. Roman officials, like their Greek counterpart, also submit their records to auditors when they leave their offices. During medieval and Renaissance period, manorialism is the organization of rural economy and society in medieval Western and parts of Central Europe, where a lord is vested with legal and economic power, supported economically from his own landholding and taxes from the peasant population under the lord's rule. These manors have some of the sophisticated and advanced record keeping and techniques during that period. Segregation of duties was observed, and the trusted personnel of the lord still listens to the recordings of the accounts by the servants. The earliest mention of public official in charge of the audit function is a reference to the Auditor of Exchequer in England in 1314. While the auditors of the imprest were established under Queen Elizabeth I in 1559 with formal responsibility of auditing exchequer payments. More positions related to audit function were formalized later on during the 17th to 19th centuries in England. Now, the big break of auditing as a profession came during the period what we call the Industrial Revolution. The Industrial Revolution is marked with great period of economic growth in England. During those times, to support larger economic endeavors, people started pooling their money and resources, and management functions were passed from the owners to professional business managers. So this is the time where the management is separated from the owners and thus gave birth to companies or corporations as we know them today. English corporations were formally registered with the state. Shareholder audits were performed by auditors who possessed little or no independence, as auditors at that time were required to own stock in the audited company, unlike today, where auditors are required to be independent. Separation or disseparation of owners from management created an increased demand for auditors, who were engaged not only to detect clerical errors, but as well as frauds. Thus, auditors began to report on the work they had performed to the owners of the company. The concept of the independent auditor was born. Sampling was also developed during this period, where auditors select few haphazard items if it's not economically feasible to examine all transactions of an enterprise. In early 20th century, American audits and British audits in England began to differ in terms of audit objective. American auditors focus on reporting actual financial condition of an entity, while British auditors focus on detection of fraud and error. Furthermore, American audit supported audit sampling, while British auditors favored detailed testing. During the period 1933 to 1940, Americans started reporting as to whether financial statements present fairly the state of affairs of an entity, while British auditors used the more precise true and fair view reporting. In the period 1940s to 1980s also marked the start of World War II, which lasted until 1945. During this period, audit sampling was now widely accepted. It was also generally accepted that the adequacy of internal controls or internal check could reduce the extent of testing by external auditors. Furthermore, it became also increasingly accepted by the auditing profession that the primary objective is the provision of opinion on the financial statements. Moving forward, businesses became more complex and computerized information systems were being adopted by the companies. So this led to search for a more efficient and effective methods of auditing. Studying and evaluation of internal controls became a standard part of the audit process. Systems-based auditing was extensively used and statistical sampling methods were introduced to further reduce sampling risk. Around early 70s, the concept of audit risk started to appear in professional auditing literature. Gradually, auditing firms adopted the modern auditing methodology, which is also known as the risk-based audit approach. So this approach involves understanding of the relationship among the risks involved in audit engagement so that auditors may properly plan and design their audit procedures. Today, risk-based audit are the standard methodology of doing audit. Now, despite the improvements in auditing profession at that time, there were still a number of accounting and corporate scandals affecting the accounting and auditing profession. That is why major accounting organizations sponsored a study as to the causes of fraudulent financial reporting and make recommendations to reduce its incidence. It was popularly known as the Treadway Commission, and the result of their work was published in a report and issued in 1987, which led to the development of an internal control framework known as the COSO framework or Internal Control Integrated Framework. COSO stands for Committee of Sponsoring Organization of the Treadway Commission, which is one responsible for making the study and issued the recommendations about internal control. Finally, major changes in auditing and accounting standards and methodology usually occur after major accounting or auditing failures have occurred. A classic example would be the case of Enron, an American energy company based in Houston, Texas in 2001. The company succeeded in manipulating its financial reports to defraud its shareholders and creditors. Eventually, Enron filed for bankruptcy and its senior officers were convicted. The company's auditor at the time, Arthur Andersen, was considered as one of the largest accountancy firms globally with hundreds of offices worldwide. However, because of its audit blunder with Enron, its professional license had been revoked and was not allowed to do audit anymore after the incident. The incident also paved way to an important U.S. legislation, the Sarbanes-Oxley Act of 2002, also known as the Public Company Accounting Reform and Investor Act of 2002, or simply SOX. According to the American Institute of Certified Public Accountants, or AICPA, Sarbanes-Oxley Act introduced the first major change in the mandate of the audit of public companies. So this new prescription focuses on auditor assessment of internal controls, which is a very important step in the assurance of future systems that will be modular, computerized, and often outsourced. Today, the accounting and auditing profession faces an opportunity to further elevate the audit to a higher level of automation in this age of artificial intelligence and big data. So therefore, it is imperative that accountants ultimately lead the way in adapting and implementation of future audit such that they continue to be the professionals of choice relative to audit engagements now and of the future.